Hi, I am Anna. I come from www.ntvforex.com. Is the $S nosedive the end of US hegemony? http ntvforex.com News ID 188628 7/22/2021 19:15 p.m. Outlook. Today we get June existing home sales, likely a nice gain given recent housing trends. Mexico reports retail sales, likely at least a small gain as everyone else has been showing. Canada reports inflation, ho-hum. We also get the EIA report on oil inventories, but the market has already made up its mind to ignore storm clouds that strongly suggest demand will be weak. In the absence of hot data, traders can mull over why gold rallied to a 9-year high yesterday, $1,854, before the usual pullback today. This was the highest since September 2011 and a 26% gain from in March when the stock market crashed. Meanwhile, the dollar has been softening but not at the same pace that gold has been rising. Pundits have talked gold half to death lately, but many of the usual suspects are still valid even if we cannot put weights on them. Loss of confidence in the US and the dollar, little else to put money into, possibly rising inflation. Also a much neglected factor, expectations of rising industrial demand, which is also pushing up silver as well as non-precious metals. See below. The $S nosedive is already being interpreted as the end of US hegemony and other silly ideas. As we have been worrying all along, a shock can put the dollar back in the spotlight as the safe haven. We think Trump is picking a fight with China over espionage and closing the Houston consulate in order to distract attention from having used his office corruptly to get the British Open at his Gold Club. But maybe not. Maybe China really did do something and got caught, which may not reduce retaliation if only for its face-saving aspect. A US-China Cold War escalation might turn the tide back in favor of the dollar. Then there is the looming crisis of some 20 million workers losing that extra spending money next week if the Senate fails to act. You'd think that would be dollar negative because it's US economy negative, but a big enough negative is dollar positive. We are not even going to try to talk about the stock market. It's probably a bit early for a second panic sell-off, which the cycle guys say should arrive in October, but they also note that cycle work is never all that precise until afterwards, when a hawk ergo propter hoc argument is so easily made. We continue to worry about the 10-year under 0.60% for the first time since April 21. What do the bond boys detect that the rest of the financial gang is missing? A little more about inflation. See the chart from tradingeconomics.com. It's somewhat surprising to realize that we are not getting zero or negative inflation in this time of the pandemic, and we did have negative rates of inflation in 2009 and again in 2015. As of June, the annual inflation rate was 0.6% from 0.1% in May. The month-over-month was also 0.6%, the most since August 2012, due mostly to gasoline. What else went up? Food and medical care. Core inflation rose 0.2% and 1.2% YY. We assume recession means deflation, but it's a lousy assumption. A fall in the rate of inflation, yes, but seldom outright deflation. Does anyone here remember stagflation 2008 and the cost push inflation in 1974 from the tripling of oil prices in 1973? And then there is the currency-led inflation that happens in countries that push their currencies lower, on purpose or not. We sometimes look down on those as mostly banana republics, but the fringies who see the White House and Fed aiming to do exactly the same thing are not nuts. Trump wants a lower dollar to promote trade, and the Fed is willing to let inflation rates overshoot 2% and the economy to run hot for a while, if only to avoid the error of the past of raising rates too early. Currency depreciation raises inflation through imports. Here the US has the self-sufficiency advantage. It is the world's biggest importer in dollar terms, but imports are a mere 15.3% of GDP. Is that enough to raise US inflation? It depends on how much of those imports are part of a supply chain and how much is finished goods. If we exclude autos, which is hideously complicated, consumer goods are $654 million of $3.1 billion imports, or 21.1%. That leaves the rest, or at least capital goods, industrial goods, foods and feeds at $1.351 billion or 43.6%, so, we guess that this is the number that would feed inflation. A crude swipe at the issue like this is nowhere close to the true answer, but makes the point that the inflationary effect of dollar depreciation may be small. The economy is about $22 trillion, after all, so inflationary goods are only 1% of that, but not zero. Our somewhat unconventional view is that the psychological effect of inflation on industrial buyers, importers, and consumers far outstrips its true role as measured by economists. People freak out all too easily. Consider the toilet paper story. There was no reason for everyone to rush out and stockpile TP. But it became a nationwide obsession and fad, and now TP costs about double what it cost before the pandemic. There is no real shortage, just a wild rise in demand. Some foods are seeing the same inflation: olive oil, canned soup. Other buyers in serious sectors, industrial machinery, are no less influenced into buying panic by rising prices than the average dimbulb housewife. See the euro on the monthly basis. Not tradable, but that red resistance line looks rock solid. Tidbit: we have never before heard a central banker declare his currency properly priced. That's what RBA Gov Low said about the AUD. Gov Low said you can't make a case for a misalignment in the AUD, even if he would like to see it lower. But the Australian dollar's value is set in the market, and we're not going to intervene to force it lower in the current circumstances. Okay, that leaves the door open for intervention, but not anytime soon. Wonders never cease. Note to readers: we will not publish any reports next week and will return on Monday, August 3rd. This is an excerpt from the Rockefeller Morning Briefing, which is far larger, about 10 pages. The briefing has been published every day for over 25 years and represents experienced analysis and insight. The report offers deep background and is not intended to guide FX trading. Rockefeller produces other reports in spot and futures for trading purposes. To get a 2-week trial of the full reports plus trader's advice for only $3.95, click here. Subscribe our channel to receive the news as soon as possible. Thank you for watching.